In this video, I'm going to share with you 3 of my favorite tips that I use when I roll over my covered call options. And to me, the most important one is the tip I use when I roll over deep in the money covered call options on stock that I want to keep owning. By the end of this video, you know exactly how to trade and roll your covered call options for consistent cash flow and return. I'm Randy Perez. I'm a 20+ year stock and option trader as well as real estate investor. This video on rolling covered calls is the second video in a 2-part video series. The one I released last week was all about rolling put options, especially ones that have gone deep in the money. So if you'd like to check it out, I'll leave a link to it down in the description below. But this week, it's all about covered calls. We're going to forget puts for a week. We're only going to talk about covered calls. I know some of you love your covered calls because you love the stocks that you sold those call options against. You sold those covered call options because you want to collect some extra cash flow, but you still want to own your stock. So this video is all about preserving the stock that you own, your favorites, whether it's Tesla, Microsoft, Apple, Nvidia, whatever it is. I'm going to show you how to save those stocks when those covered calls go deep in the money. One more reminder before we get going is I encourage you, if you have any questions as this video progresses, please leave those questions down in the comment section below. Before I share with you my 3 favorite tips I use to roll covered calls, let me first make sure that for you new folks that you know what covered calls are. When you sell a covered call, you're simply selling someone the right to call your stock away from you at a preset price, the strike price, within a certain time frame or by the expiration date. And here you see the example of a covered call that I'm going to share with you in this video. The company is KR, the Kroger company. Here I sold someone the right to buy this stock from me at any point between the day I sold it and October 18th for $55 per share. Now they're only going to do that if Kroger is trading above $55 per share, but that's what I'm selling someone the right to do. Call Kroger away from me at $55 per share at any point between the day I sold that option and October 18th. So that kind of made your head feel like it was tied in knots. That means you're probably new to option trading. So I'll leave a link for you down in the description. That's the beginner's guide to option trading that help teach you all the basics when it comes to option trading. Now let's get on to my 3 favorite tips of how to roll covered call options. The first one is a situation where you want to keep the stock, but the stock hasn't really moved around a lot. That's the case of my covered call here in Kroger. Back on October 17th, I realized Kroger it was not announcing earnings during the next option expiration cycle, so I felt comfortable staying with this position. And Kroger also hadn't really moved around much in price. It hadn't gone up a lot, and it hadn't gone down a lot. So I was comfortable rolling out that same $55 strike price. So all I simply did was bought the October 18th $55 cover call option. To keep this trade going, to keep the party going, to put some more cash in my pocket, I sold to open the KR November 15th $55 cover call option. And for that, I got some pretty good premium, especially for a grocery store company. As you see here, I got 88 cents per share, or $88 for this one cover call option contract. So I rolled it, I pocketed the money, I was on my merry way. I didn't need to worry about it for several weeks. So this is what I like to do whenever a company is not announcing earnings during the next option expiration cycle. They were not supposed to announce earnings until after November 15th, so I felt comfortable rolling this put option out to November 15th. So I bought the October option back and I sold to open the November option. That's a simple one. The stock hasn't gone anywhere, but I want to stick to the position. So this Kroger one was pretty easy because I rolled it right before expiration. Notice I rolled it on October 17th and the option was expired on October 18th. So I waited till right about the last minute to roll this one. But when should you consider rolling your covered call options? Well, if you don't want them called away from you, you need to watch your extrinsic value. You're probably thinking, here you go again, Randy, those crazy words. What's extrinsic value? I think it's easier to explain to you what intrinsic value is, and then you'll understand what extrinsic value is. Intrinsic value is how much the value of an option is there because the option is in the money. Here's an example of that. I've sold the TXN December 20th 170 call option. Well, Texas Instruments is trading for right around $201 per share. So as you see here, this option is in the money by about $31. That means it has $31 of intrinsic value because that's the amount that is in the money. So if the option is worth more than $31 per share, well, that amount would be the extrinsic value. Now, if we look at that December option chain, we see our 170 cover call option is trading for between $30.90 per share and $32.15 per share. So really there's no extrinsic value left in this option. So if I did not want this option called away from me, I better get to rolling this thing because it's very likely, especially if it's about to go ex-dividend, that it'll be called away. And the reason why I say it's very likely to be called away, because notice here the dividend is about $1.36 per share. Now it's not going ex-dividend until January 31st, so I don't have to worry about it. Let's say it was about to go ex-dividend. Why am I concerned with this dividend? Well, there's a whole strategy geared towards collecting dividends, and it's called the dividend capture strategy. You see, if the extrinsic value of this call option is basically zero, and a person can get $1.36 per share for calling your stock away from you, that's very likely to happen. But I don't have to worry about it. it's not going ex-dividend for about another 2 months. But if you owned a stock that was paying a dividend, that was about to go ex-dividend, you want to make sure that the value of the covered call option you sold has at least the value of the dividend in it as far as the extrinsic value of the option. So if the dividend is about $1.36 per share, you want the extrinsic value of that option to be at least $1.36 per share. If the extrinsic value is less than the dividend, your odds of that covered call being assigned go way up, especially as the extrinsic value nears zero. For example, I am pretty confident that if this was about to go ex-dividend, this will be called away from me because there's no extrinsic value left in this 170 call option, and it pays a nice dividend of $1.36 per share. So just watch your dividends and watch your extrinsic value when you're doing covered calls. If it's a non-dividend paying stock, you don't got to worry about it. But even if it's a non-dividend paying stock, you still want to make sure that your covered call option has some extrinsic value in it. Otherwise, it increases the odds of the call option being assigned and the stock being called away from you. I'm not going to go into a lot of detail about the Greeks. If you want to learn more about the Greeks, I discussed it in detail in that beginner's video I mentioned to you earlier that I'll leave a link to down in the description below. But if you're selling covered calls, theta or time decay is really important to you. You see, for an option seller, theta, that's our buddy. That's what puts money in our pocket every single month. And so one thing you want to consider when you're selling a covered call is the theta, or what your return will be. Let me show you what I mean. Going back to our Texas Instrument example, let's say we're in a covered call and we want to maximize our return by selling a covered call in it. Well, TXN is trading for around $200 per share. Let's look at a couple of the different returns we get going out to different expiration days, because you want to keep this in mind whenever you're selling covered call options, or especially when you're rolling them out. So notice with this December option that expires about 19 days with a $200 strike price, the annualized return is about 38.9%. How do we get that? We add the bid and the ask together, and then we divide by 2. That gives us an option value of about $5.62 per share. Now remember, that option is about $1 in the money. So if we back out that $1 in the money, we see the extrinsic value is about $4.64 per share. So we take that $4.64 per share, divided by the 19 days left in the option until it expires, and then to annualize that, we multiply that times 365 days. We then divide that by the strike price, which is $200 per share. That gives an annualized return of about 44%. And you see that's pretty close to what my broker is estimating. It's over the weekend, so the number might be a little bit off, but you see it's pretty close to what the annualized return is that you would realize for the extrinsic value of this covered call option. So how does that compare against the return we get for selling the January option? Notice that return is about 27.32%. Still a really good return, but not as high as the 38% annualized return we get for selling the December option. Just realize that although the annualized return is higher, the amount you receive for this December option, it's a lot less than the amount you receive for the January option. Notice the January covered call is selling for over $8 per share. And what about the January compared to March? Remember, January's annualized return is about 27%. Notice that March is a decent bit lower at about 19%. As you see here, if I expand this column, 19.43%. So keep an eye on your annualized returns whenever you're selling your covered call options. Of course, to me, that's not the most important factor, especially if you want to hold on to the stock, but it is a consideration. So the Kroger Company covered call is a nice example of how to roll one out when nothing has really changed from the last time you sold the covered call option. What about when the stock has gone up a pretty decent bit? I'm not saying a lot, we'll get to that one in just a minute, but it's gone up a decent bit. Here you see a covered call I rolled recently in HUM. Before I talk you through all the trade details when I rolled this covered call, let me first show you the chart so you can see what was going on with HUM. This little yellow down arrow is the day we rolled this option, November 8th. Notice over the past month, HUM had a nice advance of around 34%. Previously, we had sold the $25 covered call option. That covered call option was now in the money because HUM was trading for around $288 per share. So it was about $13 in the money. It had gone up quite a bit, so the option was kind of deep in the money. Now I'll show you an example in just a minute that had gone a lot deeper in the money percentage-wise, but this one had gone up and it was in the money. So how can we keep this covered call going? I didn't want the stock called away from me at $275. I want it called away from me at a lot higher price. So how can I avoid that covered call assignment? Here's the trade I did. I bought to close the HUM November 15th, $275 covered call. Remember, I always like to do this for a credit if at all possible. So to get a credit, I did have to go out to February, but I sold the HUM February 21st $300 covered call option. And for that, we got a pretty decent credit. We got a credit of $6 per share. So I got that option rolled way up by $25 and still walked away with $6 per share. Now I'm positioned a lot better. My covered call option is pretty close to at the money where HUM is trading. Now we'll have to go through earnings as you see here because HUM is supposed to announce earnings at the end of January, which I don't like that, but I did the best I could. I got it way up by $25 per share and walked away with a credit. But notice what I had to do. I had to go out several months. In fact, I had to go out 3.5 months to make this happen. But I was happy because the position was back in my favor and the stock wouldn't be called away from me at $2.75 per share. This strategy lets you stay in the game longer on a position that you want to stay in. I didn't want HUM called away from me at $2.75 per share. I want to keep the position going, so I rolled it up as I rolled it out, and I went out 3 months to make that happen for a nice credit. Although I'm sharing with you covered calls in this video, all these same concepts apply to poor man's covered calls. I'll now talk through a poor man's covered call that went really deep in the money on me in TQQQ. This is a 3x levered ETF that I trade a smaller position size in. Now, the short call option I sold in TQQQ had gone deep in the money when I rolled it a few weeks ago. And of course, I didn't want the call option assigned because I didn't own the shares. I'm in a poor man's covered call. That means I bought a Leaps call option and I'm selling near term call options against it. So how can I deal with one that went really deep in the money on me? When a covered call or poor man's covered call goes really deep in the money on you, you don't want to assign, you want to improve your position so you can benefit from that stock price appreciation. And that's what I wanted here with my TQQQ poor man's covered call, or you might say covered call. But first, what prompted me to go ahead and roll this position? Well, I have alerts set on all my options that I've sold. For example, here you see the TQQQ January call option I've sold that I'm going to share with you in this example. Notice I have an alert that the value of the option gets below 10 cents per share. An alert will pop up on my broker screen, alerting me to check the position out to decide if I want to go ahead and roll that position. I have it set for the corresponding $75 strike price on the put option because if this short call option has gone in the money, it will never reach a value of 10 cents per share. So I'm trying to keep an eye on how much extrinsic value is left in the $75 call option I've sold. If the put option's value is almost nothing, that means there's very little extrinsic value left in that short call option, so it's probably time to look at it to make sure it's not assigned. Setting alerts is a nice hands-off way of watching how much extrinsic value you have in a call option you've sold. Just set the alert on the put and the call for that same strike price, because if the call is in the money, the value of the option will never get to zero. So here's what our position looked like. We had sold the November 65 call, and notice how far it was in the money. TQQQ was trading for almost $80 per share. If I didn't do something, that $65 short call option was going to be assigned. So I wanted to get that option up as far as I could as I rolled it out. But I also didn't want to get it too far up. In fact, I decided around $75 is about where I wanted to be at. Let me talk through this order I got filled so you understand this third tip on how to roll very deep in the money covered calls. So just focus on the call section here. We bought to close the TQQQ November 15th 65 calls. We sold the January 17th 75 calls. And notice how much those $65 calls cost us. Sorry, that was a bunch of C's. It cost us $16.35 per share. And notice how much we got for the 75 call. We only got $10.55 per share. If we didn't do anything, then we have a debit of around $6 per share for rolling that short call option up as we rolled it out. But to help fund that, I sold some additional put options. Now, I only do this if I have position sizing available. You see, if all the put options I've sold were assigned to me, including the covered calls I'm in, if that's less than 5% of my overall portfolio, I'm okay selling additional cash carry put options against a position to help fund rolling a short call option up. However, if by selling additional cash carry put options, if they put me over that 5% maximum position size, I will not sell additional cash carry put options to help fund rolling a covered call or poor man's covered call up. But in this situation, I have position sizing available. So what did I do? Well, I had to close out my November cash carry put option, so I bought back the $60 put options, and that only cost me a penny. They were pretty far out of the money. And then I went out to January and sold that same January 17th $70 strike price put options. That paid me $2.62 per share. But notice I had sold 5 of those, and I was only in 2 of the poor man's covered calls. So as a result of all this, I walked with a credit of $145 minus commission for rolling this poor man's covered call and for rolling that cash carry put option. So a couple points here. I strongly encourage you, if you have a position sizing rule, say of 5% in any one position, keep that initial position size down to around 2 or maybe 3%. That leaves you another 2 to 3% in position sizing available to sell additional cash carry put options against a position if you need help rolling your covered calls up. By having that additional position sizing available, it helps you to reposition a short call option more in your favor so you can prevent a covered call from being assigned, a stock being called away from you, or a poor man's covered call from being assigned. Now, just a note here about maximizing your return. When you're looking to roll these covered calls or poor man's covered calls out, it's always good to compare the annualized return of the various expiration dates. For example, let's look at the annualized return on the various expiration dates for TQQQ. If we look at the December expiration, which expires in about 19 days, notice that the annualized return is about 41.56%. Well, can we get a better return for going farther out in time? Let's see. Well, if we go out to January, it's 29.42%. What about March? It's a little bit worse at 26%, but still a nice return. So although the annualized return is lower, notice how much cash you receive. Obviously, you get more for it dollar-wise. For this March option, you would get between $11 and $12 per share. For the January option, you get less at around $8 per share. And then for the December option, you get around $6.70 per share. Generally speaking, your annualized return will be higher than nearer term to expiration, but that's not always the case. So I encourage you to always look at your annualized return before you roll any covered call option. Sometimes you're better off going farther out in time because you'll get a higher annualized return. Just keep in mind that this annualized return is based on the extrinsic value of the option. Now I want to share with you a couple of bonus tips that you want to keep in mind when you're rolling your covered calls or poor man's covered calls. One important thing that happens once every 3 months is earnings. And you really got to watch out for earnings, especially if you're trying to hold on to your covered calls or you're trying to stay in your poor man's covered calls. Here you see an example of that. Digital Realty Trust is a REIT. Its ticker symbol is DLR. Notice what happened after its last earnings. It went way up in price the next day. At one point, it was up almost 18% in just one day. Just keep in mind, if you're going to sell covered calls through earnings, a lot of wild things can happen. If you really want to hold on to your stock, you might consider waiting to sell covered calls until after earnings. Yes, you might miss out on some covered call option premium, but also might prevent the stock from being caught away from you. Now, if you don't care if they're caught away from you, go ahead and sell covered calls through earnings. But if you really don't want that covered call being assigned, then you might consider waiting till right after earnings to sell new covered calls. Another tip I want to share with you is when is not the best time to roll a covered call. Here you see a covered call I'm in right now in HUM. I sold the February 21st $300 covered call. Now there is still some nice premium in this. This covered call has between $23 and $26 per share premium. So that's nice premium. But if you look at the next month, which is the March 21st expiration, that same $300 strike price, notice I could get even more option premium for that one. And it's selling for between $27 and $29 per share. So why not go ahead and roll it out now? Well, there's still plenty of extrinsic value left in this option that expires in February. And in fact, if you look at the return, the March one has about a 31% annualized return, and the February is actually a little bit higher at 34%. That's why I say keep an eye on your annualized return. If you're getting a better annualized return for the one you're in, you might consider staying in it until the annualized return kind of flip-flop, and the next one you can roll out to has a higher annualized return. Now that's not the only factor I watch when I'm rolling covered calls, but it is one to keep in mind. Speaking of when is a bad time to roll a covered call, here's one that would be bad for me to roll. It's Texas Instrument. Now I have made a lot of money in Texas Instrument over the past several years, and more recently by selling covered calls in it. So because of that, my heart might be tied to it. I've made a lot of money, I want to keep the party going, but it doesn't make sense. Let me show you why. So currently I'm in the December 20th 170 cover call. So how much can I get if I rolled that cover call out? Well, let's look. If I go out to January, that same 170 cover call, notice the return is only 4.91%. All right, let's check March. Notice the March one, it's not much better. It's just under 5%. If I go out to April, it's getting a little better, but it's only 6.32%. Do you see where I'm going with this? It's not worth it to roll this cover call. And yes, I could try and roll it up. For example, I could go out to April and try and roll it up to this 175 strike price, but notice the return is only 7.45%. I want to get a better return than 7.45% if at all possible. So because of this, I am not going to roll this cover call. Unless Texas Instrument comes way down in price and I get a lot better return than 7.45%, I'm just going to let the stock be called away from me. So this is a nice example of a situation where it is not smart to roll this cover call, at least in my opinion. Selling and rolling covered calls is one of my absolute favorite ways to generate consistent monthly cash flow and return. If you'd like to get an alert whenever I buy, stock, or sell options, check out the benefits of becoming a patron down at the link in the description below. One of the common questions I get asked a lot is, how much can I make selling covered calls? If you'd like to see the answer to that question, as well as some more of my favorite covered call tips, check out the video at the link above and the description below entitled Selling Covered Call Tips. How much money can I make selling covered calls? Until next time, happy investing, and we'll see you again soon.